live. Welcome to the Parviz Malakouti Professional Speaker Series, where I interview experts in various fields about practical and actionable tips that people can do to improve their lives. My name is Parviz Malakouti. I'm a licensed attorney focusing primarily in immigration law. And of course, I'd like to interview people as well, in particular professionals. Today, it's my pleasure to have Shiva Bhaskar here, a consumer credit attorney and a credit scores expert with Tier 1 credit. He's also one of my very good friends, and I'm going to pick his brain today in this interview and try to squeeze all of the secrets out of him. I might turn him upside down and secrets.
Go for it.
Yeah, I will. And we're going to talk specifically about the 5 biggest things that people can do to improve their credit quickly and in a free or cost-effective manner. And we're going to specifically talk about 2 things that most people are completely in the dark about with regards to credit. We're also going to talk about the 3 biggest mistakes that people make with their credit. Shiva, we've been friends for over 15 years now, since we were both in college, UCLA, of course. And I've kind of been following you in the shadows online and on social media, kind of creeping on your profiles, as they say. And I've seen you really develop into a top expert in credit. I've been wanting to, interview you for a long time. So I'm very excited to have you here. And I'm excited to learn about everything that you're going to say today, not just for people that are listening online, but for myself. So welcome.
Thank you, Parviz. Great to be here. Excited.
All right, great. So let's get into it. So Shiva, you are a credit expert and you are the founder and operator of Tier 1 Credit, a company dedicated to using software that provides people with very low cost ways to improve and maintain their credit. You're also a graduate of UCLA, both undergraduate and the prestigious UCLA School of Law. So you are a double Bruin.
Bruins.
Of course. You're also a licensed attorney in the state of California and New York. So in short, I would say your professional educational requirements in the field of consumer credit are beyond reproach. Before we get into the nitty-gritty of the interview, I just want to ask you a few questions about your personal background so all the viewers and listeners can know who's speaking to them. So how's that sound?
Sounds great.
Okay, great. And if any viewers want to skip ahead in this discussion to go right to the part where we talk about credit, they can do so easily. I've marked in the description a roadmap so they can see exactly what part of the video starts with the substantive information. Great. So Shiva, let's start from the very beginning. Where were you born?
Princeton, New Jersey, not too far from New York City, actually.
Okay, great. And I know at some point you made your way out into Los Angeles because that's where I met you. So when did you make the move to LA?
A long time ago, 1986 or so, when I was really little. So I've been here most of my life.
Okay, so basically you're a native American.
I would say so, absolutely. I certainly consider myself one.
Okay, great. And Shiva Bhaskar, of course, is not the most usual name. So what's your family?
Family's from India. I was, as I said, born in Princeton, but yeah, they're from over there and have been in the States for quite a while, actually, my parents and other relatives as well. Yeah.
Okay, great. So in origin, born in Princeton, come to LA when you're only 2 or 3
Correct.
Okay, so you went to UCLA for undergraduate and then you went to UCLA School of Law. And first of all, what made you decide that you wanted to go to law school?
It's interesting. So when I was younger, when I was a kid, people always said, oh, you love to argue and debate. So it would seem that being an attorney might be a natural fit for that. But after around the time that I graduated college, I thought that A, legal training would be very helpful. It would be a good skill to have. B, I had a lot of interest in being a corporate attorney. And basically, that means anything from mergers and acquisitions type work to real estate work, where I'd be basically reviewing and negotiating and working on business deals, whether in the real estate field, in tech, in mergers and acquisitions with private equity. That was kind of what I saw myself doing or what I had an interest in. And I imagined I would eventually move that into a business career of some sort. So that's kind of what I started out with.
Okay, great. Even though you didn't end up in the field of real estate or transactional law, it still ended up serving you, right?
It certainly did. I mean, the training that you obtained during law school, and I'll say this, for anyone who wants to go into a related field or even another field, having a legal background is really something that's very valuable. So 100%, it's been a huge part of where I am today.
Okay, great. So after graduating from UCLA Law, I know that you made your way over to New York. So roughly how long after graduating? Was it before you went, and why did you end up going to New York?
Sure. So went about a year and a half after. In the meantime, I had taken the California and New York bar exams and thankfully had passed those. But long story short, Parviz, I had a mix of feeling like I might enjoy better, or not better, but more interesting for me career opportunities in New York, combined with I had lived in New York during both summers of law school as an intern, and I loved the city. I had a passion for it, still do, and I felt like it might be a good fit for me. So I actually moved to New York without a job. My aunt, who lives in the city in the Upper West Side in Manhattan, was kind enough to take me in, and I started making my way. And I actually started out my career as a realtor. Funny enough, renting apartments in New York because I needed money, I needed something to do. Got started. Eventually, as I made my transition into being an attorney and doing commercial litigation out there at a mid-sized firm, that's kind of where I got my start. And eventually ended up doing some pro bono work, which is actually kind of led me in the direction of where we are today with Tier 1 credit.
Okay, great. Before we get into how that pro bono work led to what you do today, I just want to ask you, as a young professional that's lived and worked in both Los Angeles and New York City, what do you think about the difference in the lifestyle between the two?
Sure, sure. So I love both places. I really enjoyed being in both. The one thing where I think New York is really unique is because there's a subway and a bus and Uber, which is, quick distances. It's a small area in terms of geographically with a lot of people. It's very easy to connect with folks, whether those be new friends, old friends, potential business partners and colleagues. I don't know, romantic partners, whatever you want. It's very easy to meet up with people and travel around, and that's something I really enjoyed more than I did in LA. On the other hand, LA has far better weather, so always a trade-off, right?
Okay, thanks. You're fine. You're fine either way, I guess.
Absolutely.
Okay, great. So you mentioned a moment ago that you started doing some volunteer work, and I know personally that that volunteer work is kind of what led to what you do today. So what was that volunteer work that you started doing in New York?
Correct. So, Parviz, I had an interest in a couple things. One of which was I wanted to help make the legal system more accessible, and I believed that there was a way to use technology, really technology as a solution or a vehicle for doing so. And when I looked at where the law was confusing and where we could help people, I saw lots of areas, but one that I honed in on was debt collection. And New York is a very unique place when it comes to consumers and consumer debt, in that the court system in the five boroughs, it's Queens, Manhattan, Brooklyn, Staten Island, and the Bronx, customers who are being sued in debt collection cases are able to get help from attorneys and law students in court once to twice a week by basically what happens is volunteer attorneys, folks from legal aid, and law students would come. So I signed up and started volunteering first in Brooklyn, then in Queens and the Bronx as well. And what I consistently saw was that folks who were being sued for unpaid debts, say to credit card companies was the biggest source of it, sometimes medical. One big concern they had was their credit score, because New York, as everyone probably knows, just like LA, is a very competitive real estate market. To even rent an apartment, you need a strong credit score. Otherwise, even in some of the roughest areas, they wouldn't take you without decent credit. And so credit was consistently a concern, and folks either didn't understand how it worked or they needed solutions on how to improve their score, along with all the legal issues around debt. And that's kind of what led me to where we are today.
Okay, very nice. And was it in New York that you met your business partner today?
Right. So basically, what happened was around the time that I got involved with Calero, that's a clinic in New York, the one thing I neglected to mention, I myself actually had credit issues.
Oh,
So
wow.
I had gone late and delinquent on my student loans after I moved to New York because I wasn't bringing in any money at first. And as a result, I damaged my own credit, so much so that initially I couldn't qualify for an apartment on my own or anything like that. And Tony Budry, who is my co-conspirator and business partner, is a childhood friend of mine who started out in the mortgage business at about the age of 21, 22, when he was finishing college at UC Irvine. And Tony had learned how to help his clients with credit issues, in part by pairing up with another attorney in LA, who's no longer in the area, but was here for a long time. And they worked together to help folks with credit issues. Tony was able to help me with my student loan lates and help me get my score up. And then just Based on that, plus the need we saw in our friendship, we started talking about the potential to work together. And we started working with some folks and found that we had a fit in terms of the services we were offering and working together. And that was several years ago. As they say, the rest is history.
Nice. And so basically, in your quest to find out how to improve people's credit, you had skin in the game too, right?
Absolutely, absolutely. I've been there with Navy and Sally Mae were the companies that did my student loans. I've been there with them calling me on the phone, going into forbearance, being denied for several credit cards because of my poor credit, even after I brought the loan current. So yeah, I've been in the game myself. Absolutely.
Wow. Wow. Okay, great. Okay, great. So we have a little bit of background about you, and I am very excited to get right into 5 things that people can do today or tomorrow, but preferably today, to improve their credit score. So, Shiva, we know that people fall into bad credit for all different reasons. A student loans is a super popular one. I mean, I think everybody knows one or multiple people that have fallen behind on their student loans. I certainly have at some points before as well. The point is that when someone's in trouble, they got to find out how to get out. So we'll focus the rest of the interview on what somebody can do, actionable items to improve their credit. What's the first thing that somebody can do to build and improve their credit?
The first and probably the simplest thing you can do is become an authorized user on someone else's credit card.
Okay, okay, great. And is that something that's fairly easy to do?
Yeah, it's pretty simple. So basically, what you're trying to do, we call it piggybacking. You're trying to make use of another person's strong credit history on an account, meaning the fact that they've always paid on time and that they've had the account open for several years and that they have some amount of credit limit, at least a few $1,000s, hopefully. So you want to find someone, maybe a parent, an uncle, an aunt, a mentor, even a friend or a sibling who's a few years older than you, anyone, or even younger if they started building their credit early, anyone who's had at least one credit card for, I would say, at least 2 years, ideally longer, and has a limit over $1,000, ideally over $5,000. They always pay on time, and they don't spend typically more than about 30% of the limit on the card. Reason being, if they go way above that and use too much of their available balance, that can hurt your score. Basically, what you do is have them add you as an authorized user, and depending on the credit card issuer whom they work with, their account will appear on your credit reports as well. And the great thing for them is that it's risk-free in that they don't have to give you a copy of the card. They can basically add you, get the card, put it in their drawer or in their wallet, the authorized user card, and it'll start appearing on your credit report. And you don't have access to the account. So it's a really easy way to get someone else to help you because there's no risk for them of you using the card and not making payments or doing other things that get them in trouble.
Right. You just addressed to be my very next question, which is, do they even have to give you access to it? Because I would imagine if you have crappy credit and you're asking somebody for help, their first thing, the first thought is going to be, well, I hope this person.
Right.
It, right. Okay. So that's great. So obviously you don't even have to make a single expenditure on the account.
Not at all. Not at all. You don't even need the card. You don't need the card at all.
Okay, great. Next question is, how long from the time somebody does this, becomes an authorized user on somebody else's credit card, how long does it take before it starts making an impact on their credit?
Sure. So I would say 4 to 8 weeks. And the reason why I say that is because after you're added, it will typically take anywhere from 4 to 8 weeks for the account to appear on your credit reports. And I should clarify something, Parviz, that regarding what I mentioned earlier, not every credit card issuer will report authorized users to credit bureaus. For example, I have a card with Chase, and I had a friend of mine ask me to add him to help his credit after he had a few challenges. This was before I was even in the industry. And we gave his info to Chase, but they didn't report it. They never even asked for his social. Their policy is not to report people. But other companies, for example, American Express, Discover, a number of others, I believe Wells Fargo, they will report it. So you have to find out whether your card issuer or your friend or relative's card issuer will report them. But yeah, it varies, but often they do.
Okay, so we know that American Express and Discover tend to report.
Correct. And several others, yeah.
Okay, great. Okay, next question regarding that that action, and one that everybody always asks. How much does it cost to do this?
It should cost nothing if your friend or relative is willing to help you without charge, considering there's no risk to them, usually it should be essentially free. I mean, in a lot of families that are financially savvy, the parents will add their son or daughter when they're 18 or 19 to their credit card without giving them the card to help them start building credit. That's something that's common, but it should cost you nothing. I mean, there's no risk to them, so usually they're not going to charge you. But along the lines of cost, there is one sort of scam I want to alert people to regarding authorized user. There are companies that do what they call selling trade lines. What that means is they will get a set of people who have credit cards with high limits, and with those people's permission, they will get other people to sign up and be approved or be added as authorized users, and they'll take a cut and they'll give the person who added the authorized user a cut. Two reasons not to do it. First, you shouldn't have to pay someone something like that to build credit. Find someone who can do it. If not, there's a lot of other steps. Number two, authorized users have less and less impact the more accounts you add. So the first authorized user account really helps you, but more than one or two, it will help you, but not as much, in part because the credit scoring companies, like FICO that is, have figured out people are doing this and they've adjusted the formulas accordingly. So that's why.
Yeah. I'm big into the FIRE community, financial independence.
Sure.
And one of my favorite podcasters, the Dough Roller, advocates exactly what you mentioned. He has two children, and he mentioned that when they became 20, 21 years old, he added them as authorized users as well. So so it sounds like you and the Dough Roller are in agreement.
Glad to hear.
Absolutely. Before we move on to the second item, anything else you want to add about this particular strategy?
One thing I would say, it's not going to have as much of an impact as opening your own accounts, which we'll talk about later, I know. But I think it's a good place to start, either for someone who's new to credit or someone who has poor credit and needs a bit of a boost, or even, and this is a big hack, someone who's 5 or 10 points away on a mortgage for a better interest rate. This is a hack that loan officers use a lot to get people that extra 10 points and get their mortgage rate down. So it's an effective tactic when used with several others, for sure.
Nice. So let's move on. What is the second thing that somebody can do?
The second thing that I would recommend is opening a secured credit card.
Okay. And how does it work? How does somebody do
Sure.
that?
So basically, a secured credit card is what the name implies. It's secured. What it's secured by is your deposit. So it's basically as if you're going to provide a deposit, which equals either part or most of the spending limit on the card. So by providing such a deposit, you have reduced the risk for the credit card issuer, because if you don't pay, they obviously can go into your deposit if you default, and they're guaranteed, if they set the limit at your deposit, you won't spend more than that. I mean, technically you could rack up other fees, but the point being, it's low risk. So for either people with no credit or with bad credit, secured credit cards are a great option. And two of the most popular ones are Discover and Capital One. We suggest clients for either of those companies. In some cases, if they have severe credit issues and they really want to accelerate their credit building, we'll have them sign up for both. But basically, you sign up for the card. You use it about once per month to make a purchase that you would have anyways. So let's say gas or groceries or lunch or something like that, something you would have bought anyways. Instead of paying cash or a debit card, use your credit card, pay off the balance, meaning do that purchase and pay it off immediately. And what will happen over time, your on-time payment history will be reported to all three credit bureaus. And as a result of doing that, that account will be a positive account that pulls your credit score up. And as long as you keep paying on time and you keep your spending on the card low, it will definitely benefit your score.
Okay. So are you saying basically that there's diminishing returns on making more than a single purchase per month with that credit card?
I would say there is, for two reasons. First, there's no annual fees on these cards. I should mention that, and that we'll get to in a minute. But you always want to stay below 30% of the spending limit, meaning you don't want to spend more than 30%. So if you do a card with a $250 limit, never more than 75. Now, what happens if you make multiple purchases? You might lose track. You might say, oh, I went and bought lunch with it. Then another day you go and buy lunch again. Now you've made two purchases. What if it was a fancier lunch and you went a little bit over? It's not that the card is going to get recalled, but it could hurt your score a bit if you go over 30%. So I always suggest just one purchase per month.
Got it. Okay. So I assume that somebody can do this just in a day, right? It's just the same as opening a credit card?
Correct. It's just like opening another credit card. You can either call Capital One or Discover. You can visit their website, or one of the platforms we really like for financial education in general and for understanding these things is NerdWallet. That's nerdwallet.com. They can go there, or they can go to Credit Karma as well, but we're big fans of NerdWallet. They can go sign up from NerdWallet or on their own through Capital One or Discover directly. Yeah.
Okay, great. Is there any cost to somebody besides the amount that they put down to actually secure the credit card?
There's no cost. There's no annual fee. And if you pay off the balance in full every month, and like we said, we're only making one purchase per month. If you do that, you wouldn't pay any interest either. Now, if you do carry a balance, the interest rates are as high as any other credit card, from 14 to maybe 23, 24%. But if you just make one or two purchases and pay off the balance, there's no other cost besides what you bought. No.
Okay, great. Actually, I'm going to go on a little bit of a side tangent right now.
Sure.
You mentioned something which I always heard throughout the years, and I believe there's a lot of confusion about, which is whether you actually have to carry a balance in order to build your credit. Could you speak to that for a moment?
Sure. The answer is no, you don't have to carry a balance. And I do know where that misconception comes from. So there's two dates that matter when it comes to your credit card. The date your statement is generated, and then by law, your payment cannot be due more than 3 weeks after that. Now, the balance that appears on your credit report is your balance as of the date your statement was generated. So in my case, one of my cards is a Chase Freedom. The balance is generated on the 10th, and the payment is due the 2nd of the following month. So what will appear on my credit reports is my balance as of maybe between the 9th and the 11th, usually the 9th or the 10th. That's the number that'll show up on my credit reports. So I often suggest to people, right before your statement is generated, that one purchase you're going to make per month, it could make sense to make that purchase. But as long as you're keeping the card open, it's possible to have zero balance as long as you keep using the card, because otherwise they'll close it. As long as you keep using it, you often can have zero balance and be just fine and have a great score. In fact, a lot of the people with the best scores will have 4 or 5 credit cards. They'll do a little spending and have a small balance on one and zero balance on all the others, and they have 750 to 800 credit scores. So you don't have to carry a balance or go into debt to build credit, not at all.
Great. How long does it take for this particular strategy, opening up with a secured credit card, to have an effect on somebody's credit?
Sure. So within 4 to 8 weeks after you open the account, it should appear on your credit reports. Now, as far as having an impact, if you're brand new to credit, meaning you have no accounts on your credit reports, usually FICO, which is the main company that generates credit scores for lending, they need at least 6 months of data to generate a credit score. So if you're new to credit, for the first 6 months, you may not have a credit score. After that, it'll start making a score. But when we're working with clients in credit repair, I always tell them to assume that they should have the card open, active, and being paid for at least 6 to 8 months to see any real impact. And if you talk about a year or more, then you'll see a bigger impact. And the beautiful thing with these cards, Parviz, if you keep these cards open, whether new credit or bad credit, for 8 months to a year, you often will be upgraded to an unsecured card, meaning you'll get your deposit back, and you'll have a higher spending limit and unsecured. So there's a lot of benefits to it. Yeah.
Okay. Assuming that you don't go ahead and abuse it, right?
Yes, we have clients who have gone open secured credit cards before they came to us to rebuild their credit, and unfortunately they ran into trouble, and those secured cards that they wanted to help improve their credit ended up paying late on them, and it's not a good way to go. So I only suggest opening secured card when you're confident you can pay the minimum amount and pay off your statement each month. Yeah.
Okay, great. Okay, so to recap, the first strategy was to add yourself as an authorized user to somebody who has a high credit score. The second one is to open a secured credit card. What's the third strategy that somebody can use?
The third one that I really like is opening a credit builder account or a credit builder loan, depending on who you ask. That's the terminology.
Okay, what is a credit builder account or a credit builder loan?
Sure. So here's how it works, Parviz. Basically, you will go to a company, the lender that is, and tell them I want to open this account. What they'll do, they'll set aside some amount of money for you in a savings account that earns interest each month. Let's say $300, okay? That will be earning interest, obviously not a lot of interest because interest rates are still low as of December 2018, now that we're discussing it, but it'll earn some interest each month. What you're going to do is make a payment towards that principal, that balance. So let's say they set aside $300 for you, and they said for 1 year, you have 1 year to pay this off. They put the 300 in the savings account, which you cannot access. Each month you pay them $25. And that payment of $25 is reported to all three credit bureaus. Now, it's easy to get approved for these accounts because there's no risk to them. Because if you stop paying, they just, they keep the money or the portion of it that you didn't repay. So there's no risk to them, so it's easy approval. But it helps you by reporting each month that you've paid on time. And you might say, why don't I just do a secured credit card? Why do I need this account? The thing is, when it comes to your FICO score, 10% of your score, not the biggest factor, but still a factor, is having a mix of credit, meaning a mix of different type of accounts. So you have a credit card. It's also good to have an installment account, meaning one where a fixed amount is owed, like a student loan, an auto loan, a mortgage, a personal loan, a credit builder loan. So doing this lets you open that loan. At the end of the 12 months when you've been paying that 25, you're going to get back the following amount. You put in they put aside 300 for you. It's going to be 300 plus the interest that was earned from the savings account minus their fees. And the reason why they're charging a fee is because they put that money in a savings account. They could have lent it out as an auto loan or a mortgage or something else and earned a much higher interest rate from that borrower. Instead, they put it aside to help you build credit, and they took a lower interest rate. So you are going to pay. So let's say that you had a $300 credit builder loan. You probably will get back about $240 to $250. The rest of it is interest. But after 12 months of it, you've had 12 on-time payments on an installment account. You've definitely helped your credit score, even after 6 months, really.
Okay. You use as an example $300. In reality, is that something that could work to improve your credit score, or is that just really small?
It can work. And here's the interesting thing. With installment accounts, the amount owed on the account, it is a factor in the FICO score, but not as much. If you have a small loan, the real thing that counts is paying on time. Mm-hmm. If you have a small loan that you paid on time each month, it really shows that you're a responsible borrower. And if you have negative accounts, it reduces the impact of them a little. And if you're new to credit, it gives you a really solid slate to be working with as far as a new set of on-time payments. So really what it counts for is not so much the loan amount as all the on-time payments you'll be enjoying.
Okay, great. And then for a credit builder account, is that something that is more useful for somebody with no credit trying to build, or is it also equally useful for somebody who's wrecked their credit that's trying to rebuild?
Sure. So I would say it's useful for both. I think it's a little more useful for people who are new to credit because it gives them an installment account, things of that nature. A lot of people who have bad credit, they went bad on their mortgage or their auto loan and their student loans. So they already have installment accounts. They just haven't done well with them. But even folks who are looking to rebuild their credit, we tell a lot of them to do secured cards as well as credit builder accounts for the simple reason that the more you do when you have bad credit, the more positive accounts you add to your credit reports, the more your score will go up. So I recommend it for both.
Okay, great. You mentioned the fees that the institution will take. Sure. What do they charge in fees for a loan like this?
Sure. So the companies that I have in mind, Self-Lender is the biggest company known for doing credit builder loans. That's the main product they offer. A local credit union might also offer one. Now, if I go off of Self-Lender, which is the most popular one, their cheapest plan, I believe for either 12 or 24 months, is $25 a month. And let's say that you did the $300 loan, they probably will take about $50 to $60 of that $300 in fees and in interest that they charged you and all of that. So you'll get back about $240. But at the end of it, you really built a much stronger score. And the thing I always tell folks is, if you're planning on applying for a mortgage or auto loan, say in a year, the money you're going to save by having a higher credit score far outweighs the fees that you pay to Self-Lender or anyone else.
Of course, yeah, exactly. I mean, if you're talking about several $100,000 purchase and an interest rate, $50 or $60 is absolutely nothing compared to the money you save with the higher score, obviously. How long does it take to have an impact on your credit score if you open a credit builder account?
Sure. So if you're brand new to credit, just like with a secured credit card, it'll take at least 6 months to generate a credit score. So if Self-Lender or a similar product were the only account you opened, you didn't open a secured card, it'll take you at least 6 months. But for most folks, I would say you might start to see a bump in about 3, 4 months, and a larger impact in probably about 7, 8 months. And here's the other thing to remember, Parviz. If you are looking to raise your score a little bit, say for a mortgage or something, so you're doing some credit repair, getting a few bad items removed, plus this, you can repay the loan early. So let's say you signed up with Self-Lender and you started making payments, you got your credit score up to the level you wanted in 7 or 8 months, you can pay off the balance of the loan right then to avoid further interest costs. So a lot of folks use it for 7 or 8 months to get their score where they want it, and then they pay it off. So that's an option as well.
Okay, great. Anything else you'd like to add about this strategy before we move on to the fourth?
Only thing I would say, the common complaint we get is, why am I paying interest and paying money to build credit? You don't have to do it. You can just do a secured credit card if you want. But we've found that having a good mix of accounts really helps boost your score. And that in turn saves you a lot of money in the future. So I think it's a good financial trade-off.
Okay, great. Shiva, what is a fourth thing that somebody can do to build or rebuild their credit?
Sure. This is perhaps one of the fastest acting things you can do. It's just the cost of it potentially. Reduce your credit card debt or your credit card utilization, as I said earlier, to below 30% of the limit. So if you have a card with $1,000 limit, try to keep your spending, or your use of the card when your statement is generated, below $300, because that's below 30%. The more that you can do that, it really is going to boost your score, for the simple reason 35% of your credit score, the biggest factor, is your payment history, meaning paying on time. Number two, 30% is your debt. Specifically, your credit card or revolving account debt is a big part of that 30%. So getting your balances, again, below 30% of the limit is really useful for you.
Okay, great. So below 30% at least, and really, if you're on top of things, under 10%.
Correct. Under 10% would be ideal. When we advise clients, we always look at their overall financial picture. What I tell folks who are looking to buy a home soon is try to get under 10% and even under 5% if you can, because the money you put towards paying it down will increase your score enough that it'll save you as far as having a better interest rate. So, yeah.
Okay, great. How long does it take for this to have an impact on someone's credit score?
Sure. So that is sort of, it depends is the answer. And the reason it depends is because everyone has different levels of credit card debt. If you have tens of thousands of dollars of credit card debt and not that much income, it's going to take a while. If you don't have a lot, maybe just 500 or 1,000 or even a couple $1,000, and your income is such that you can pay it down, then it'll be a quick process. So really it depends on your situation. The good news is there's a couple of strategies you can use to help you get there quicker, or get there more effectively, I should say. I mean, one thing we have clients do is what's called the debt avalanche method, or debt snowball and a debt avalanche. Debt snowball, I know, we're basically, it's like a snowball. It gets more momentum as it starts rolling. You basically focus on making minimum payments on every credit card, except for one, where you pay the minimum plus any extra money you have each month based on your income. Once that account is paid off, you take all of that money, the minimum plus extra, and pay it towards the next smallest debt while making minimum payments on all the others. And so a lot of people, the snowball approach really builds confidence for people who've had financial issues in the past. And as we'll talk about later, I think mindset is a big issue when it comes to this. So I think it really gives confidence. Another approach to easily reduce or more easily reduce the credit card debt would be the debt avalanche method, where you pay off cards in order of interest rate, because the highest interest card is costing you the most. So pay that down, then the next highest. So there's a lot of strategies.
Okay, great. What about opening up another credit card to utilize balance transfers? Is that something that you advocate, or you think that's not a good idea?
I think it can be a great idea, and personal loans can also be a great idea. There's two questions to ask. One is, with a balance transfer card, you're transferring the balance to a new card where there'll be no interest owed for a period of time, anywhere from maybe 6 to up to 15 months. It used to be even 24 months, but they've cut that back. So for that period of time, you won't be paying interest. So if you think you can pay off this debt in 12 to 15 months, then it makes a lot of sense. If you can't, it may not, because then the interest rate is going to be fairly high, just like other credit cards. So it is an option. The one thing I need to mention with balance transfer cards, usually you need at least decent credit. You need at least a 640 or 650, usually higher these days, to get most of those cards. Another option you have along those lines is a personal loan. if you have at least a 650 or 660 credit, you can take that loan, use it to pay off the high interest debt, and then, once that's done, pay the loan company each month. Now, these loans are not going to be 3 or 4% interest. They're going to be high interest, like 9, 10%, but that's lower than most credit cards. So both of these are good options if you already have, a decent credit score, but just a lot of debt, a lot of credit card debt. It can be a good option. For people who are new to credit or have below a 640 or 650, I wouldn't recommend it because they probably won't qualify for those products.
Okay, one quick follow-up question regarding the balance transfer card. If somebody wants to go that path, they still should keep the total debt under 30% of what the limit is, correct?
Correct. And they're going to have an issue there because if you transfer a lot of debt, you're going to have a high balance or high utilization above 30% for a while. But the good news is if you've moved it over, it's no longer growing because it's not accruing interest each month. And so it's something you can tackle a little more easily. So you absolutely should get it paid off. And the other thing I should mention, balance transfer card means 0% interest for the balance transferred only. The reason I'm saying that is some people get a balance transfer card, transfer a balance, then they start doing new spending on that card, and they carry a balance from month to month. You'll pay a very high interest rate on that balance. So when you get a balance transfer card, put it in the drawer, put it wherever. Do not use it. Only focus on paying down the balance as close to zero as possible so that you can get your debt down. Do not use the card at all.
Okay, great. So with regards to the cost of reducing your credit card balance to below 30%. Obviously, there's the cost of paying down that credit card. But besides that, of course, there's no extra cost. It's just a regular payment to your credit card, right?
There's no extra cost. I mean, most balance transfer cards do not come with with an annual fee. A few of them do, but often they have lower interest rates, so they could be worth it even with the annual fee. Personal loans, obviously, you might pay a loan origination fee, but nothing besides it. But no, other than the money you're paying towards the debt itself, there's no other cost to reducing credit card debt.
Okay, great. Anything else you want to add about that strategy before we move on?
Sure. It is one of the fastest and most effective ways to improve your credit, whether through a balance transfer, debt snowball, debt avalanche, or personal loan. When you look at it from the standpoint of the mortgage world, where my partner Tony comes from and has done a lot of loans, one of the first things he used to tell his customers and had his whole team do it was to reduce their credit card debt so they could get a better interest rate. So it's a very powerful strategy if you can afford it financially.
Okay, good. If you can afford it financially, right? What is the fifth thing that somebody can do to quickly, or not quickly, but to over the long run, build or rebuild their credit card?
Sure. No worries. This applies to people who, rather than having no credit, have bad credit, okay? And that is repairing your credit, meaning removing negative credit items like collections, late payments, repos, bankruptcies, any type of negative item.
Okay, great. How does somebody do this? I would imagine that can be pretty intimidating for somebody that's, trying to deal with that.
Sure. It is a complex process. So what I specialize in as an attorney is two federal laws, the Fair Credit Reporting Act and the Fair Debt Collection Practices Act. And the Fair Credit Reporting Act is the main one that we'll focus on here. The FDCPA, the other law, does have a relation, but we'll touch on that. The FCRA, as we call it, the Fair Credit Reporting Act, it governs everything that happens around credit reporting. And it's a federal law, passed in the 1970s, 1970 itself, actually. And it says a lot of things, but there's a few that are really important for our friends who are watching this. And that is everything on your credit report, Parviz, has to meet a lot of requirements, but three that matter here. They have to be 100% accurate. What does that mean? Say you had a collection account, okay? You didn't pay a credit card debt, it went to a debt collector. There's a lot of different information within that account as it appears on your credit report. Date open, date closed, payment history, amount owed, the account number, name of the company, date of last payment made. Every piece of that information should be correct. Otherwise, you have errors that you can challenge, okay? And often we use those errors to eventually push for removal of the account. And that takes me to my second point, which is verifiability. There has to be proof of whatever appears on your credit report, meaning if, say you stop paying your credit card and you owe $2,000, and it's never just 2,000, it's always 2,034 and 72 cents or some crazy number. But they have to be able to prove that exact number is correct based on interest calculations and based on the contract you signed. The dates that you supposedly didn't pay have to be correct. And they have to be able to prove that, meaning provide an account statement, provide the contract on the account, things of that nature. That has to be proven in order for there to be a case, really, as far as them being able to keep it there. So verifiability. And the third thing is timeliness, meaning things cannot stay on your credit report past a certain time. Most items cannot stay on your report for more than 7 to 7.5 years. And for certain types of bankruptcies, 10 years. So often one thing we see is someone stopped paying on a debt and it went to collections. The debt collectors sometimes do what's called re-aging. They try to keep a debt on your credit report by claiming that you first stopped paying at a later date than you actually did. So that way they can keep it for more than 7 years. We often see a lot of debts, a lot of auto repossessions that turn into collections. A lot of those stay on the reports longer than they should because of either lies or even just random confusion in when the client actually stopped paying or when the customer stopped paying. So point being, if the requirements of accuracy, verifiability, and not being too old, meaning timeliness, are not met, then the item either has to be corrected or removed from the credit reports. Now, depending on who you ask, many or most credit reports, as much as 70%, have some sort of error. So you can challenge and dispute accounts on your credit. And if they cannot either show the information is accurate or prove it, or it's too old, then the account information has to be removed.
You gave me a ton of information to unpack right now. Let me go right to what I think probably the most people are thinking, which is, how do you challenge this?
Sure. So there's a couple ways to do it, but what we recommend is obtain a copy of your credit reports from annualcreditreport.com. Annual Credit Report was created by federal law. It said that every consumer in the United States has to be given access to their credit report once every 12 months. So go there and you can get your 3 credit reports from Experian, Equifax, and TransUnion, excuse me, which are the big 3 credit reports. Once you have those reports, either online or by mail, you want to look at which accounts are negative, which ones are hurting you. And this is a complex process, but if you have a collection, if you have charge-offs, if you have a repo, late payments, those are hurting you. Then you want to write a letter to each credit bureau telling them some reason why you think the account might be inaccurate or that you'd like a certain aspect of the account to be proven. So you could say, I believe the balance is wrong on a collection, or I believe the payment history is wrong, things of that nature. They have by law 30 to 45 days to investigate your dispute and get back to you. And basically, through disputing, you're going to build a case, or if you're working with a credit repair company or an attorney like us, we're going to help build a case showing why information on a particular account or accounts are incorrect and should be removed. So you want to send this letter by certified mail, because if they don't respond to the letter, that could be that is a violation of the law, and you can use that to your advantage. So basically, you need to write letters to the credit bureaus and eventually to the company that placed it there, so the debt collector or Chase or Capital One if you didn't pay one of their accounts, whatever it may be.
Okay, interesting. So just so I understand correctly, if you have one debt, okay, that you want to dispute, you have to address it by mailing separately all 3 credit bureaus, correct?
Correct. You have to mail all 3 credit bureaus. If you have multiple accounts you want to dispute at once on one letter, you can do that. You can challenge. We don't recommend challenging more than 3 accounts at once, because part of what the Fair Credit Reporting Act says, they can deem a dispute frivolous, which means they don't have to investigate it. If you challenge every bad account, then they know that you're just trying to get things off and they can mark it as such, and then you really hurt yourself. So you got to contact every bureau for each account as it appears on that bureau. And the reasons why they're wrong could be different between different bureaus, but you have to contact each one, and I don't recommend challenging more than probably 3 items at once.
Okay, great. So 3 at once maximum, so you're not deemed to be making frivolous challenges. Okay, so let's go through a quick timeline. Somebody drafts a letter, they send it to, let's say they only want to dispute one account. Okay, sure. They draft the letter, they send it to all 3 credit bureaus. Okay, sure. Those credit bureaus then have between 30 and 45 days to respond. Is that correct?
That's correct. They have 30 to 45 days to respond.
Okay, and within those 30 to 45 days, they have to go and actually contact the holder of the account to verify the information, right?
Correct. They have to contact the holder of the account. This is not done the way you would think, which is a thorough investigation. Instead, they use a software called Metro 2, okay? or sorry, eOscar. Metro 2 is what's used to report the information. They use eOscar and they type in a number while you're disputing it. So you might just say generally inaccurate, or they might say the customer challenges the balance owed. They'll type in a number. They won't even usually forward the letter you wrote them. They'll send that number over to the data furnisher, we call them, the company that placed it there. That company will investigate it and come back. And that investigation often is very sloppy. It means they just look at it and say, yeah, that looks right, and send it back verified. So most things don't get removed on the first round. And so the entire process for one item can take up to 6 to 7 to 8, really up to about 8 months to get it resolved. You might have to dispute it with the credit bureaus up to 4 times. You might have to, after a few rounds, dispute it with the data furnisher, like the collector or Chase or Capital One. Eventually, you'll want to have it looked at by an attorney to see if there's lawsuit-worthy violations. And you may have to contact the Consumer Financial Protection Bureau, Federal Trade Commission, your state's attorney general. Point being, one account can go on for a while. There's nothing in the law that says that they have to correct. It says that the credit report has to be accurate and that disputes have to be investigated. But there's nothing to say that doing it once is going to remove it. And it's a big issue. It can take up to 7 or 8 months per item to get it resolved.
Okay, so you mentioned in the beginning of that explanation 1 round. So that implies, of course, that there could be multiple rounds of going back and forth regarding the same account, right?
Correct.
Okay.
I'll give you a quick outline, or just, if you want a quick outline, I can tell you.
Please, go ahead.
Usually you write one letter to the credit bureaus, they respond, then you accelerate or you find a different thing to dispute within the same account. Second round. Third round, you get more aggressive. Third round, you also are going to contact the data furnisher, that's a debt collector or the credit card issuer, contact them directly. The reason why you contact them after you dispute with credit bureaus is if there's a serious violation, like a lawsuit-worthy violation, it would only actually work if if you had first disputed with this company. If you did not dispute with the credit bureaus first, you can't sue. So you always got to go to credit bureaus first, then the collector, and then basically at that point you should be able to find all the violations and then contact both the collector as well as the credit bureau. And at that point you contact a CFPB or an attorney and others and make it work from there.
Okay, and before we get into how much this process might cost and who specifically can assist with this process, I just want to make sure that we understand, as far as timeline, we're looking at the very earliest, an effect within 30 to 45 days, but realistically more like several months. We were just mentioning a moment ago that this could take up to, well, of course, there's no upper limit, but sure. It's very common that it could take several months, 6, 7, 8 months for this process to take place. How much does it cost to go through this process for somebody?
Sure. That's the $1 million question, although I can assure you it won't cost $1 million. But the answer is it depends. You, by law, are allowed to challenge information on your credit reports yourself and do the process on your own. There are books out there that help you with it, as well as other resources. But like anything else, you can also fix your car on your own. You can find a home on your own. You can do a lot of things. But often when you work with an expert, depending on who that expert is, and if they are in fact an expert, it can be easier. So if you choose to do it on your own, it's free. It's just a cost of time. And the fact that if you don't know exactly how to dispute something or what the legal arguments are, you might have a lower chance of prevailing. If you work with a credit card company or credit repair company, such as our firm does credit repair, amongst other things, it could cost as little as a few $100s if you just have 1 or 2 items. It could cost a couple of $1,000s if there's lots of items, or if you choose a company that does monthly fees. We don't. But I would assume if you use a credit repair company, you should assume a fee from about $400 to about $1,000 as a cost. Yeah.
Okay. $400 to $1,000. Okay, great. And in a moment, or a little bit later, in just a couple minutes, I'll ask you a little bit more about what you guys do specifically and how somebody can reach you if they want to talk to you
Sure.
about repairing their credit. But before we get into that, I want to ask you about the top mistakes, and we're going to breeze through these really quickly.
Yes.
As you know, Shiva, they say an ounce of cure is worth a pound of prevention.
Right.
Actually, no, excuse me. It's an ounce of prevention is worth a pound of cure.
Oh, okay. I thought, okay.
Anyway, so what are the top three mistakes that that people make with their credit that can be avoided?
The biggest one I see, probably the most obvious, is paying late on an account. And obviously, the more often you pay late, the more likely it is to go to collections and charge-offs and so on.
Okay, great. What's the easiest thing for somebody to avoid a late payment?
Well, the easiest thing you can do is pay on time. And the easiest way to make sure you pay on time is set up automatic payments, or auto pay as we call it, where the amount due will be deducted from your bank account on the date or right before the date when the payment is due each month, so that you don't have to think about it. That's definitely the easiest thing to do.
Okay, does auto pay typically cost anything?
Auto pay doesn't cost anything. In fact, most lenders prefer you do auto pay. Um, for example, a lot of mortgage companies like Chase, if you get a home loan through them, will even credit you a couple $100s if you sign up for auto pay. So it doesn't cost anything to set up. You can do it online. It's totally very low cost, takes about 20 minutes, really simple.
Okay, great. What's the second biggest mistake in your experience?
If you run into trouble with your debts, meaning you see you have financial problems, you lost your job, you went through a divorce, whatever it may be, you started a business that didn't work out, not corresponding with and finding ways to work it out with your creditors. So when you start running into trouble with your credit card payments, kind of not telling your credit card issuer, kind of not responding to notices, not letting them know. Because yes, some of them can be a hassle to deal with, but if you tell them they want to get their money and get paid too, they usually will try to find some sort of solution that works. But the longer it goes on, it goes into collections, it becomes charged off, then the impact on your credit is much larger, the effort required to remove it is much larger, and the chances of removing it are also not as good. I mean, credit repair works, but it's not as easy. So just, correspond, communicate when you have problems. It's the number one thing you can do to avoid that.
Okay, makes sense. What's the third biggest mistake?
Sure. One thing that we see a lot is just excessive credit card debt, meaning people just use their cards for everything. Sometimes, you know what, times are tight. They're looking for a job. They're between jobs. They had a medical expense, so fine, they're putting that and they can pay it down. Other folks just, as they say, they over leverage. They do too much holiday shopping. It's December 11th right now, and Christmas is 2 weeks away. That's a big issue right now, obviously. Just overspending on your credit cards, because when the interest costs add up, it's going to be a lot more than what you spent, and it takes a while to get out of.
Okay, great. Now, Shiva, I know you're a big fan of budgeting apps and accountability groups. First of all, what's a budgeting app?
A budgeting app, mint.com, is the one that I like the best. It basically looks at your expenses and your earnings and helps you figure out how you can reduce those expenses and how much you should be spending. And it's a really, really effective way of sort of, making sure that what you spend does not outstrip what you make. So mint.com is completely free. We encourage a lot of our clients and just a lot of my friends and family in general to sign up for it. And the other thing I suggest is accountability. So there's an app called Stick, I believe it's STICKK or STICKKK. But either way, it basically says you're going to make a commitment, and if you don't follow through on the commitment, you're going to lose money. Meaning, suppose that you said, I'm only going to spend $40 this month, $40 this week on eating out, or $20. If you spend more than that, at the end of the week, you're going to report how much you spent. And that money, if you failed that commitment and spent, say, $50, you're going to lose the amount of money you made in your commitment. And the reason why Stick works, it was created by a doctoral student of Richard Thaler, who won the Nobel Prize in economics this year. Basically, there's a concept in economics and psychology called loss aversion. Not to go down a rabbit hole, people are more motivated by fear of loss than the potential for gain. So you're creating yourself an artificial fear of loss, and that might help you stick to your commitments better.
Where does that money go that somebody would lose on Stick if they don't stick with their commitment?
Great question. It can go a few places. So one, it could go to Stick just because it's free and it helps them. It could go to a friend of yours, or, say that you have a brother or sister who you ask to hold you accountable. If you don't do it, it'll go to them. Or you can give it to a charity. They have a list of charities. It'll give it to them. Or an anti-charity. For example, if you're a Republican, can go to the Democrats, or vice versa, so on. Because a group that you don't agree with, because that pressure of not giving it to them might motivate you even more.
That's funny.
Very
Um,
clever.
he is very clever. A side note, I use Mint actually. I love it. I'm not in an accountability group, although that sounds pretty powerful. I may have to check that out myself.
I really implemented it the last 2 years. It's been amazing.
Okay. Okay. Great. Okay. So Shiva, let's move on to Tier One Credit. Okay, which is your company, of course. You mentioned throughout the interview some of the things that you guys do. I want to hear the full pitch. What are all the things that Tier One Credit does, and what are the things you guys really focus on?
Sure, sure. So at Tier One Credit, we are, as I mentioned, I'm an attorney. My partner is a mortgage lender and a finance expert. We focus on helping people enjoy the best credit score possible. There's a few ways we do that. Probably the biggest or the most well-known one is we use the credit repair process, meaning what I mentioned earlier with the Fair Credit Reporting Act. We use that to help clients remove negative items from their credit reports. We also advise folks on how to use other strategies to build credit, like secured cards, like credit builder accounts, like authorized users. We put together a plan. So, each client is different and they might need a different mix of those products. So we often help people do that. Or even sometimes people who are new to credit and want to build credit, people who are new to the country. So we help them build credit, we help them rebuild credit. And we also advise businesses on business credit, which is different from personal credit. It's also has a credit score, but it's scored differently and it's based on different things. But we work with a lot of business owners and even individuals who we helped with their credit, but they also own a business. And we've also advised our business on how to build credit and borrow so that they can grow and expand and do all those things.
Okay, great. And I understand you guys have a blog too, right?
Correct. We do have a blog. Our website is tier1credit.com. And we post on there a few times a week and write articles about money management, credit repair, debt, even credit cards and mortgages that might be good options for people. Really just everything around credit and financial education is what we focus on. And we're in the process of joining you in the YouTube world. We are building our YouTube platform as I speak. Encourage everyone to follow the Uncensored Credit Scores show. And, for those who are watching, Parviz will share the information. That'll be out in the near future, and we'll be sharing lots of information on these topics.
Okay, great. So the Uncensored Credit Scores show. And once you do get that YouTube channel up, what type of videos can people expect from you?
Sure. So they can expect videos around building and improving and rebuilding your credit, videos around budgeting, money management, saving, and also videos on lending and borrowing, meaning things to do when you apply for a mortgage, things to keep in mind, how to maximize your credit card points, how to save for retirement and invest for retirement. So a lot of topics around financial empowerment is generally what you can expect. Yeah.
Okay. How often do you guys expect to put videos out?
I would say we'd have things on there a couple times a week, and we'll also be under the same tagline on Instagram. So on Instagram, we'll be sharing, features, stories, and photos, and quick videos, and all of that. So a couple times a week. So we're calling it Tux, TUCCSS, but spelled like Tux, the Uncensored Credit Scores show. So yeah, it's not out yet, but it will be in the near future, and encourage you to follow us there. And we're looking forward to sharing a lot of great content.
Okay, great. You mentioned earlier in the interview that there are plenty of books out there for people that want to improve their credit. You're also working on a book yourself, correct?
Correct. So Tony and Tony's my partner, as I mentioned, are working on a book, not yet titled, which will walk people through the process of both managing their credit, building their credit from scratch, and rebuilding their credit if they have run into bad credit challenges. And more broadly, how to be financially savvy, whether that's in things like mortgage and auto loan and credit card borrowing or saving for retirement. So it's really going to be the primary focus is credit, but also, once you have good credit, you're saving money. What do you do with that money? We're going to focus on that as well.
Okay. Do you guys have a tentative release date for it yet?
Yeah, I would say that the second half of 2019, possibly sooner, but most likely hopefully probably the end of the summer or so is what we're looking at right now, getting everything finalized. But we're really eager to share that, and we'll be doing lots of promotions and trainings and other things when the book comes out, so that people can get the most value out of it, and we can really help our community.
Okay. And the second $1 million question: how much do you expect you're going to charge for that book?
We're figuring that out. I'm thinking somewhere in the range of about $15 to $20. We want something that's going to be very accessible to the public, and we're going to include a lot of information. I mean, pretty much everything that Tony and I use to build or rebuild credit for our clients, we're going to be sharing it in the book. Obviously, the application of it and those things, people really have to pay close attention and dig in. But everything that we do, we're going to share in the book. And we're going to include a lot of trainings for folks who buy the book and things that they can use to further themselves along in the process as well.
Okay, great. So Shiva, before we wrap up the interview, I'd like to finish with going over two really common misconceptions about credit. As you and I spoke about this before the interview, there's a lot of crappy information floating out there about credit repair, including some things that are just misconceptions and some things which are just completely flat out wrong. And I know that you were really passionate about setting the record straight on two items. So let's get right into it. What's the first thing that you want to set the record straight on?
Sure. So basically, what I've noticed on YouTube and online as well, there's a sort of rumor going around, fake news, if you will, that had to go there, right? But basically that there's a section 609 in the Fair Credit Reporting Act that lets you remove almost any negative item by claiming there has to be a signed contract in place. Now, here's the thing. Section 609 does not say anything about a signed contract, really. It does have other requirements around the Fair Credit Reporting Act, but Section 609 does not say what a lot of people on the internet are going around telling others it does. And the reason I mention this is people are sending letters citing Section 609 to credit bureaus and getting marked as frivolous. I'm in a Facebook group for our industry with other attorneys and other folks who work on credit repair. We recently found out that someone I believe in Florida or maybe Texas, went to federal court and filed a lawsuit under the Fair Credit Reporting Act, citing Section 609 and claiming that there was no signed contract and the items could not appear on his report. There's no requirement that a contract be signed there does have to be a contract when you originally borrow money, okay? But there's no requirement of an original signature or anything like that. What's more, sending a generic Section 609 letter there's cases where it works, but there's other strategies that would have worked also. And there's a lot of cases, most, where it does not. And people are going and paying for court costs and filing lawsuits because no attorney would do it, citing this section. It's pretty nonsensical. It's one of those times when sometimes you want a quick fix, so you avoid doing the work of finding out what works. The sections of the Fair Credit Reporting Act that are more relevant are Sections 614 and 623, which govern disputes with credit bureaus and disputes directly with data furnishers. And there's so many powerful strategies in there to use. I don't know what the whole obsession with Section 609 is, but you're at serious risk of being marked frivolous, and it's probably not going to be effective if you use it. So tell people to stay away from 609.
You know what, Shiva? That's tragic news. I want to believe in Section.
Well, send a letter and see what happens, but I can tell you it usually doesn't work.
Oh, that's a bummer. Okay, great. What's the second big misconception you'd like to help clear up?
So this is really around mindset. And this is around the way that we talk to ourselves and we define issues for ourselves. And a lot of people, because they have poor credit or they're in a lot of debt, they define themselves as being a person who has bad credit or is in debt and is not taking care of these things. That doesn't just become what they're going through. It becomes their mindset. It becomes who they are. And that's really destructive for a few reasons. And we talked about this. I wrote about this on LinkedIn the other day. But basically, by making a circumstance or a situation that's happening to you into who you are, and this applies beyond credit to just life in general, you are going to discourage yourself. You're going to reduce the chances that you can effectively resolve it. And it's sort of going to change your mindset. Instead of being, this is a temporary challenge that I'm dealing with, this becomes, this is who I am. I can't get out of it. It shapes your overall approach to life. And you start making excuses too. You say, well, I'm a bad credit person, so I don't pay bills on time. That's what I do. It's who I am. Thing is, it is possible to improve your credit. Going through bad credit or going through a situation that caused bad credit does not define who you are. It's not a pleasant thing to deal with, but you can deal with it. And you shouldn't think of it as something more than what it is, which is something you're going through. Les Brown, one of my favorite motivational speakers, he has a great saying. He says, this has not come to stay. It has come to pass. And keep that in mind. It's not come to be with you forever. It is something that's here today. And if you take the right actions, it'll be gone tomorrow or 6 months from tomorrow.
That's a great point. I'm really glad that you actually just said that. So many, first of all, you know, I'm obsessed with the health, self-help movement, and I read all those, a ton of books, and so much of, you know, what we do begins with our mindset. So you absolutely, you got to get out of the mindset and not look at it as part of your identity. You know,
Exactly.
something you're going through that can be, you know, resolved like anything else.
Correct. Correct.
Great. Shiva, before we get into the last part, which is just me giving you information and thanking you for being here, is there anything else at all that you'd like to add to anybody watching this?
Sure. You know, in a nutshell, Parviz, good credit seems really complicated, but it's actually quite simple. Comes down to a few things. Have a few open credit accounts, whether a credit card, an auto loan, student loan, a mortgage. Have at least ideally 3 accounts, but even less if that's what you can afford now. Always pay on time. And if it's a credit card, keep your debts low. You know, don't spend more than 30% of the limit. If you just did that, always paid every bill you have on time, and not just your credit accounts, but you know, your cable bill, your medical bills. If insurance is involved, have them take care of it. Your utility bills, all of those things. If you pay every bill and every debt you owe always on time and pay all your credit accounts on time, nothing will go into collections. You'll have a perfect payment history. It doesn't require you being rich to build great credit. You just need a couple accounts and paying bills on time and not overstretching, and you absolutely can enjoy a great credit score. And the reason why it matters so much, you can save so much money with good credit. I mean, there was Liz Weston, who writes for NerdWallet, that website I mentioned, and she also does a column in the LA Times. She calculated about 7 or 8 years ago that the cost of bad credit over a lifetime could be over $200,000.
Wow.
Like, the difference, I show clients this often, the difference on what you pay on a mortgage on a $200,000 house, okay, which granted is not one in here in California you would find, but across the country we have a wide audience. 200,000, you will pay potentially 10,000, 15,000 extra with bad credit on a $200,000 loan over the years. And if you're talking about a 400, 500, a million, lots of money. Same thing with auto loans, credit cards. So bad credit has a high cost, but great credit can save you a lot. And that's money you can save, you can invest, you can do a lot of things with.
Okay, absolutely. If somebody wants to get in touch with you, Shiva, what's the best way to reach you?
Sure. So fastest way to reach me, I'm going to do something we often don't, which is share my direct line. It's 310-968-5547. Again, that's 310-968-5547. Text is definitely the fastest, but if you do call me, I will call you back as soon as time permits. Reach me there and say hello. You can also email me at Shiva, SHIVA, at tier1credit.com. That's TIERONECREDIT.com. And I know you're putting it in the show notes. But yeah, texting me or calling me or emailing are definitely the fastest. You can also visit us at our website, which is tier1credit.com. Again, TIERONECREDIT.com, or facebook.com/tier1credit. Any of those. And, once we get Tux going on Instagram and on YouTube, you can also comment on our videos on Tux, and we'll be responding to every comment, and we'll share our information there as well if you need to reach out individually.
Okay, that sounds great. Of course, I will put all that information in the description of the video now that you've given permission to do so. Shiva, it's been really a pleasure having you here. You gave a lot of very useful information. I know I definitely was listening with an ear towards things that can apply to myself, and I will be trying to use some of those items that you mentioned. So I think that's it for now. Good luck on publishing the book, and I'd love to have you back as soon as your book is published.
I would love to be here, and we will definitely send along some announcements around things we're doing, and also we'll be doing a lot of things online when the book comes out, like a sort of launch party, really helping customers with a lot of actionable steps they can take. So I'll be sure to share those with you as well, and love to invite everyone from your audience to join us and work on their credit.
Awesome. Sounds good. Have a great day.
Thank you, Parviz. Take care. Bye-bye.
I know.